The White House says a decision by OPEC Plus to cut oil production is a clear sign the group is aligning with Russia.
OPEC and its partners have taken a new step that may change the U.S. market. They have decided to pause production increases, holding back plans for 180,000 extra barrels per day. In this video, we will explain how this move may affect gas prices and energy bills, and the long history of power struggles between U.S. shale producers and OPEC. Watch the video till the end to see how these changes could also impact your gas prices in daily life. Background and history. OPEC was formed in 1960 by 5 countries: Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. They united to gain more control over their oil sales and set fairer prices for their resources. At that time, the United States led the world in oil production. American companies controlled supply and set market rules. As global oil needs grew, many nations wanted a stronger voice in how prices were set. In the 1960s, oil was abundant and affordable in the U.S. However, global demand increased and Middle Eastern countries saw a chance to have a fair share of the market. They believed that their oil should bring better benefits to their people. This led to the creation of a group that could work together and speak as one on the world stage. But a major event changed the oil market. In 1973, several Arab nations stopped selling oil to the United States due to political differences. This decision led to long lines at gas stations and higher prices at the pump. The move showed that oil could be used to influence global decisions. It also gave these nations a stronger role in setting oil prices. And during the 70s, U.S. oil production began to decline. The country started importing more oil from abroad. At the same time, OPEC grew in strength. The group used its production limits to affect world prices. Decisions made by OPEC then had a wide impact on many countries. Moving forward, the United States experienced a rise in shale oil production in 2011. New techniques allowed companies to extract oil from shale rock, increasing U.S. output significantly. This change altered market dynamics once more. Even with this increase, OPEC still holds a major share of the world's oil reserves. OPEC countries now control nearly 70% of proven reserves. Moreover, smaller nations have started to adjust their energy deals. Some countries are signing long-term contracts to lessen their reliance on traditional oil sources. This shift adds a new chapter to the ongoing challenge between U.S. producers and OPEC. New energy partnerships are forming. These changes bring fresh competition to the oil market and show that the fight for market influence is still very much alive. We have looked at the long history of oil power struggles and the turning points that shaped the market. Now our attention turns to OPEC's latest decision. How will this hold on production affect oil prices and competition? The bold move, OPEC's latest decision. OPEC and its partners have recently decided to hold back on increasing oil production. They had planned to add more barrels each day. Instead, they chose to pause these increases. This decision has a big impact on the market. The plan was to add about 180,000 barrels per day. In total, this would have meant 2.2 million barrels more over a year. Holding off on these increases means that supply will not grow as expected. This is a clear move to manage global oil prices. The choice to pause production comes at a time when oil markets are very sensitive. A small change in supply can shift prices quickly. Many traders watch these moves closely. They know that any change in supply can affect prices around the world. This move is significant because it shows that OPEC and its partners are careful in how they control the market. OPEC's strategy here is simple. They want to keep oil prices at a steady level. By not increasing supply, they aim to prevent prices from dropping too low. This move helps them maintain market power. They believe that a steady supply supports stronger prices. At the same time, this decision is a clear distinction to the approach taken by the United States. U.S. producers have focused on increasing output, especially with shale oil production. U.S. companies have worked to push higher production levels in recent years. The U.S. strategy has been to flood the market with more oil. This difference in approach shows 2 different ways to handle the market. OPEC's move also shows a careful look at future trends. They know that even a small increase in production can lead to a drop in prices. For example, 180,000 barrels per day may not sound like much, but it adds up over time. Over a year, it could be 2.2 million barrels. These numbers have a real effect on global supply and price levels. Traders and investors pay close attention to these figures. They adjust their positions based on such changes. New insights suggest that this decision may also be a response to changes in global demand. Countries like India and China have been signing long-term contracts for LNG and other energy forms. They are working to secure stable supplies for the future. This means that OPEC and its partners are not just thinking about today. They are looking ahead at how the market will evolve. Their move to pause production increases is part of a broader strategy to manage supply and demand over the long term. This decision also sends a signal to the world showing that OPEC and its partners are willing to work together. They plan their moves carefully. This decision is based on numbers and careful planning. It is not a sudden change. Instead, it is a response to current market conditions and future expectations. We just saw how OPEC is using production holes to influence global oil prices. Now let's look at the U.S. response. How will American oil production and refinery challenges match up to these changes? The U.S. response and market impact. U.S. production has grown a lot in the last decade. The United States now produces about 15.6% of the world's oil. U.S. production has grown a lot in the last decade. Yet compared to OPEC's output and vast reserves, American oil still has to work harder. OPEC nations control nearly 70% of proven oil reserves. They set supply levels that have a big influence on global prices. This situation keeps the market tight and competitive. Many U.S. refineries are built to handle a mix of light and heavy crude. Light crude is easier to process, while heavy crude needs more work. Most American refineries are designed for heavy oil. When OPEC holds back on increasing supply, it limits the options for refineries. These facilities cannot easily switch to a different oil type. This means they must pay more for the oil they need. The higher cost then flows to the consumer. Gas prices and heating bills can go up as a result. The pause on increasing oil production by OPEC and its partners adds extra pressure. A smaller supply often leads to higher prices at the pump. Many consumers feel the effect when prices rise, even by a few cents. These changes ripple through many areas of the economy. Traders and analysts keep a close eye on these moves. Even a small shift, such as 180,000 barrels per day or 2.2 million barrels over a year, can cause noticeable changes in the market. U.S. companies may try to counter these effects by ramping up production. They have increased output in recent years thanks to shale oil. However, increasing production further is not an easy fix. Building new wells and updating refineries require time and money. Meanwhile, consumers may start to see higher prices. The cost pressure on refineries is clear. When they cannot easily change the type of oil they process, they must invest more in technology or accept higher costs for raw oil. This situation has put American refineries in a tough spot. Some companies have already reported rising costs. They now face the challenge of meeting production targets while managing higher input prices. This financial strain can lead to increased prices for products such as gasoline and diesel. The change in oil supply can affect many aspects of daily life, from fueling cars to heating homes. Meanwhile, new energy contracts in other parts of the world add to the pressure. These agreements can limit the oil available to U.S. buyers. Global competition for energy supplies grows stronger. U.S. refineries must contend with both domestic production challenges and shifts in global trade. The current market shows that any change in oil supply has a wide impact. The U.S. must balance growing its production with the reality of higher costs from global shifts. The challenge is clear. American producers and refineries now face rising economic pressure. They must adjust quickly while keeping an eye on global trends. After the U.S. struggles with rising costs and production challenges, the story widens. Let's see how these shifts affect consumers and investors around the globe. What does a tighter market mean for your wallet and investment portfolios? Keep watching to learn more as the stakes rise high. Global effects, consumers, and investors. The decision by OPEC and its partners to hold production increases affects not just the U.S., but many nations. Countries in Europe, Asia, and the Middle East now study every number and policy change. Investors in energy stocks have reacted quickly. Many have seen their stock prices shift when news about production changes breaks. For example, companies that focus on oil extraction or refining may experience a rise in their shares when supply is held steady. On the other hand, stocks of companies that depend on cheap oil may drop. The currencies of oil exporting countries also show changes. When oil prices rise, these currencies often get stronger. In contrast, countries that import oil may see their currencies weaken. This adds a layer of risk to the global market. Investors must now balance these risks with the potential for gains. The rise in oil prices does not only affect the trading floor, it touches everyday life. When oil prices go up, the cost of gasoline typically follows. Many drivers see a rise in fuel costs, even if it is just a few cents at the pump, but the impact goes further. Higher oil prices often lead to more expensive heating bills in the winter. In many countries, oil is used to generate electricity and heat homes. As prices climb, consumers may have to spend more on their energy bills. The effects are also felt on grocery shelves and in the cost of goods. Shipping costs, which depend on oil, can increase. This can lead to higher prices for food and other essential items. Every increase in oil costs can ripple through the economy. Families may find that their budgets are stretched a little thinner each month. This global change has a personal impact on households around the world. Many small nations have started to look for alternatives. Some countries are signing long-term contracts for LNG and other fuels. They want to secure stable energy at a predictable cost. This move is seen as a way to protect their economies from sudden price changes. Investors watch these moves with interest. They see a potential shift in market power as new energy deals are made. Such contracts can reduce the risk of sudden price hikes. In addition, some experts say that the market is in a state of change. New energy sources and methods are being explored. While oil remains a key resource, these changes may offer a cushion for consumers in the future. The global market now faces a period of adjustment as it adapts to new deals and evolving strategies. The impact on consumers and investors is clear. Higher oil prices affect daily expenses and market moods. Every move in the oil market now carries weight far beyond the trading floor. The changes are real, and their effects are felt by everyone, from small families to big investors. With consumers feeling the pinch and investors reacting quickly, the oil market continues to shift. It's time to examine how new players and fresh energy deals are reshaping the global field. What changes lie ahead as emerging nations forge their energy paths? New insight, emerging power players, and future trends. New power players are changing the oil game. Countries like India and China are reworking their energy deals. They are signing long-term LNG contracts to secure steady energy supplies. Regional players in Asia and the Middle East are taking similar steps. They aim to have more control over their energy future. Such moves show a clear change in the global balance of power. Smaller nations are stepping up too. Many are exploring new contracts and partnerships to reduce their reliance on traditional oil. Several Southeast Asian countries are working together. They are setting better terms with oil suppliers and sharing resources. These changes come as global demand grows, especially in developing economies. New LNG deals and other fuel contracts are being signed. This trend may lessen the influence of traditional oil powers on the market. At the same time, investments in renewable energy are on the rise. Many governments now support projects in solar, wind, and other clean energy. This mix of fossil fuels and renewables adds variety to the energy market. Energy stocks and currencies tied to oil exports show quick changes when new deals are made. A change in supply agreements can bring both risks and opportunities. When smaller nations secure long-term energy deals, it adds a new layer to global oil politics. Investors adjust their portfolios as these contracts come to light. They study the numbers and news to manage risks and look for gains. The shift in energy deals is not limited to big nations. Many smaller countries are taking careful steps. They are entering contracts that promise steady prices over many years. This approach gives them more certainty in an often unpredictable market. Such actions have started to affect the overall flow of global oil. New partnerships are forming that change the traditional power structure in the industry. New trends also point to a more varied energy market in the future. As countries lock in long-term LNG deals, they prepare for a time when oil may not be the sole major fuel source. Investments in renewable energy are growing steadily. Although these sources are not yet large enough to replace oil completely, they add important variety. Many nations now plan to use both oil and renewables. This strategy could help balance supply with demand and may lead to steadier prices over time. Energy experts note that these moves could change the way markets work in the coming years. With new contracts and shared resources, countries may reduce sudden price shifts. Investors see this as a chance for more stable returns. The The fresh focus on both traditional and new energy sources is shaping a market that many did not expect just a few years ago. The world of oil is now set for a significant change. New deals, shared resources, and a mix of energy sources are making the market more varied. Countries large and small are working to secure their energy future in ways that could shift global power in unexpected ways. After decoding fresh energy deals and new market players, the next step is clear. What options lie ahead for the US and the world? We now will look at possible paths, whether diplomatic talks or market countermoves. Options for the US and the world. What next? The US and the world now face two clear choices. One is to start diplomatic talks to ease tensions. The other is to make a market countermove. Diplomatic talks may help to calm the market. They can lead to agreements that keep oil prices in check. However, such talks take time and require trust from all sides. A quick market countermove, like flooding the market with more oil, can cause chaos. It may lead to a sudden drop in prices, hurting many businesses. A rapid response carries its own risks. It can destabilize prices and strain relationships between nations. On another note, the US is not just focused on oil. There is growing investment in renewable energy. Wind and solar power projects are getting more support. These clean energy sources are rising. Still, oil remains the main fuel for many industries. Renewables are part of the plan, but are not ready to replace oil overnight. Oil still runs many cars and factories today. The US is working to add more renewables, but the switch will take time. The blend of old and new energy sources is likely to continue for years. Looking at the numbers, the US produces about 15.6% of the world's oil. In contrast, OPEC controls nearly 70% of proven oil reserves. This gap shows that any move in global supply can have a large impact. A sudden increase in US output could lower prices quickly, but it might also hurt domestic refiners who rely on heavier crude. On the other hand, if diplomatic talks work, it could mean steadier prices and less market shock. Experts believe that both approaches have their own risks and benefits. Diplomatic solutions may lead to longer-term stability. They could help set rules that many countries follow. Market moves can bring short-term relief, but may create new problems. Investors watch these moves closely. They adjust their investments based on how these options play out. In the end, the world stands at a crossroads. The US and other nations must choose how to respond. They need to weigh immediate actions against long-term strategies. The choice will affect gas prices, consumer bills, and the overall market. All eyes remain on the upcoming decisions, as these will shape the future of the global energy market. From shifting production plans to new energy deals, every decision counts. Share your thoughts in the comments and join the conversation. Please like and subscribe for more updates. Stay with us as we follow these changes and keep you informed about what comes next in the world of oil.